What's the right type of financing you should be getting for your business? Look, there's 4 different types of main categories of money you're able to get for your business, and you got to choose wisely. Because if you choose wisely, you'll be able to get the most money at the best terms, and you're able to get money right out the gate. I mean, right from the beginning of launching your business, you're able to get the money you need to do so. So during this training, I'm going to decode these 4 ways that you can actually get the money you need to grow your business. And by the end of this training, you're going to know how to get each of these different categories of funding so you can launch a business, grow and scale it successfully, getting all the money you need along the way. We got a lot to cover, so let's dive in. Okay, so there's multiple different ways to fund your business. There's actually too many options, and that's the problem we have as business owners. I call this the cash access problem because there's no limit to the amount of money that's available for us. The problem is we don't know how to access it. We don't know where to go to get it. There's actually too many options. It's an overwhelmed situation. So let's break this down and simplify it by looking at the 4 different ways that entrepreneurs can really get money. Number 1 might be something you can relate to. It's called bootstrapping, right? And a lot of business owners are bootstrapping their business using their own personal credit, their own personal funds, and money from people around them, like good friends and family that are just giving them cash. As a matter of fact, 75% of entrepreneurs launch a business using these kind of methods in this actual category. Now, bootstrapping, you run into a lot of problems. And the first thing you run into is what I call financial checkbait. You run into financial checkbait because of this. First of all, running a business usually costs a lot more money than you think it's going to, and it takes a lot longer to get results than what you think it will be. Look, I've been an entrepreneur for decades, and I can tell you I still struggle with these 2 things. They still cost way more than I think and take way longer to get the result that I anticipate. So how do you get around that? Well, first of all, you look at one of the 3 other ways to finance your business, but let's talk about if you stay on this path. See, ultimately what happens is you start using personal credit to fund a business. Then what happens is it takes a lot more money than you think it is, and it takes a lot longer to start generating revenue. So you quickly start to max out those personal credit cards. Maybe you even try to get more, but your limits get lower and lower the more you apply because you've maxed out your credit limits, which is really lower your credit scores. I call this financial checkmate because you ultimately max out your personal credit so much where it's hard to then turn around and get personal or business loans that you could have got if you wouldn't have ruin your personal credit by using your personal credit cards to fund your business. So you need to avoid personal checkmate financially, and this is going to happen if you're using personal credit especially to fund your business. Keep in mind, 30%, nearly a third of your entire consumer FICO score is based on utilization. What are your balances compared to your limits? The higher the balances in comparison to your limits, the lower your credit score is going to be. Serious damage to your credit score when you're using personal credit cards to fund a business because they weren't designed to do that. So bootstrapping a business, it's one way to do it. A lot of problems involved. Number 2, most common way a business owner funds a business is called debt financing. Debt financing is like when we use credit cards or credit lines or loans to be able to fund our business. We're taking on debt. We're paying points. We're paying interest. We're borrowing money from a lending institution typically. They give us money. They give us terms. We pay them back payments on those terms, and they give us the money for that, right? That's exactly what happens. And with debt financing, it's one of the most common ways we can fund a business. Now, the great news is that you can start building business credit right away. I mean, like day 1 of starting your business, you can start getting business credit. You can get $10, $20, $30, $40, $50,000 individual limit credit cards actually for your business in your business name without a personal guarantee, without a personal credit check, within weeks or months of starting to build business credit. So this is a great way to actually get debt financing the right way initially from the beginning. Stop using personal credit and using business credit to fund our business. Now, when we do this, we're getting these high limit cards. We're using it to grow the business. The business is generating revenue. And once the business starts to generate revenue, now we can get cash flow financing. Now we can get SBA loans and term loans and all these other types of financing that become available. So the key here with debt financing is to use business credit, build a credit history for our business that helps us get loans and credit lines, use business credit to fund the business initially, start gaining momentum. Then that opens up all other kinds of debt financing for us. And that brings me to category number 3. Category number 3 is venture capital. This is private equity. It's angel investing. It's not money from lending institutions, but it's money from actual individuals, okay? Now, angel investing falls into 2 categories, affiliated angels and non-affiliated angels. Affiliated angels are people that are like around you, your family members, your friends, people that you might be able to give ownership interest in the business in exchange for them putting money in. Almost all equity raising, all venture capital, all angel investing starts here where you're going to the people around you to invest. Then you bring in these non-affiliated angels, and they want to see that people that you know trust you enough to put in money, because wouldn't you? Like, think about that. Like, wouldn't you want to know if you're going to lend to somebody that like their friends and family would lend them money? That's a good sign that they're trustworthy if other people around them know, like, and trust them enough to give them money. So these unaffiliated angels start coming in and putting money in. And again, you use that money to fuel your business. Once you start generating revenue, you start opening up the door for debt financing. Or you never go down that road. You stay down the venture capital road, meaning the angel investors are putting money in and you're growing the business. They introduced you to venture capitalists. Now, venture capitalists aren't going to invest in the startup stage of a business. They want to see you've got momentum. They want to see you've got a product or service. They want to see the market has accepted what you have. Sometimes they want to see that you've reached a level of profitability. So eventually, you can then grow the business to get venture capital worth hundreds of thousands or millions and get outside investors to invest in your company. You know how this works. It's how Uber was built. It's how Airbnb was built. It's how Facebook was built. It's how almost all of the largest publicly owned companies and privately owned companies exist, is they raise this money through angel investors and venture capital. And that's that category 3 of how you get money. And category 4 is like random. It's just like the other stuff that doesn't fit in those categories. It's crowdfunding, for example. It's grants, for example. Those don't fit in one of those other categories, but they are still viable ways to get money to grow your business. So if you have some unique concept or idea, you're creating like a little widget or a product the world hasn't seen, launch it on a crowdfunding platform. Places like Indigo or Kickstarter are great places to launch this kind of new concept or idea, get wild acceptance, and get the crowd of individual peers to then put money in to actually want to invest in what you're doing. Okay, now the other thing is grants, right? Grants is free money. Grants doesn't even have to be paid back. So grants is another good way. And you can go to grants.gov, for example, and grants.gov will get you access to government grants, which is the biggest category of all grants that exist. Now, this will get you free money to actually grow your business as well. Now, keep in mind, you don't have to stay in one of these 4 categories. You can and should cross over. Meaning that once your business starts to grow, it opens up more of these options. But by knowing the 4 main categories, you know the categories you can move into. So you might start with angel investing, people around you that put in your first 50 or 100 grand. You get the business off the ground. You start generating revenue. Then you go to debt financing using revenue lending, right? Then you grow the business to 7 figures, right? It's worth $1 million. Then you go get money from a venture capitalist and they put in another $1 million and you double the size of the business within a year. You can easily go across these categories to get all the funding you need to grow your business. So hopefully this helps you. By understanding these categories, you know the options you have, and you can now strategize about the best ways to fund your business. If you need help with that strategy, let us know. At Credit Suite, this is what we do. We help you improve your fundability, build your business credit, and get financing to start and grow. So again, you can get a free 100% free assessment in working with us, and we'll talk to you about all of the options that you have. So make sure you get in touch with us. Did you get value from this training? If so, like and subscribe, and keep your eye out for our next training where we talk about more cool ways to get the money you need to start and grow your business.